having some more people to register or come online within the next 10 minutes or so. This is our first webinar, the KOGA Summer Series webinar, brought to you by CountryMark and Ergon. We also have some sponsors I'd like to recognize who have also sponsored today's webinar series, which include Aqua Clear, Bingham Greenbaum and Dahl, Bitco, Black Ridge Resource Partners, Britannia, CountryMark, Diversified Gas and Oil, InLink Midstream, Ergon, Hughes Land, Phil Brown Insurance, Reliance Well Service, Steptoe and Johnson, and Wyatt Terry & Combs. Now, this webinar series will be every Tuesday at 2 p.m., and next week we will feature the Kentucky Secretary of State, Michael Adams, who's going to give us an update and a discussion on the Kentucky primary election that will be co-hosted by the Kentucky Coal Association. So we look forward to that and look forward to the other speakers on down the road. The other speakers down the road will include the Division of Oil and Gas Director Dennis Hatfield and some fine folks at the Kentucky Geological Survey who's going to give some information on their progress during the coronavirus. We'll also hear from CountryMark and Sean Bailey with Diversified Gas and Oil. And we'll release that schedule of events as we get further down the road. This is in lieu of our annual meeting, as you know, it has been canceled for this year. And we just want to thank again our sponsors and everybody who is joining us today. We do have a survey after this, so if there are topics that you would like to know about or if there are technical difficulties that you experience, this is our inaugural event, so we'd like to know that and improve your experience for the next call. Let's see here. I believe we're going to go to, we've had a couple of commercials, a couple of online vendors who are going to play during this. So we really appreciate their sponsorship and support during these uncertain times. So I guess Michael or Stacy, I'll turn it back over to you, and then we'll go right into our next featured presentation by John Henderson. So Stacy, Michael, thank you.
Okay. Stacy, ready for me? Okay. Good morning, everyone, or good afternoon. This is the, as Ryan said, this is the first in our summer series. We would obviously have liked to have been together to have our annual meeting. This is the first time we haven't gotten together in, I don't know, certainly decades. But what we're going to try to do is basically give you some information that may be useful today about, in my case, the change that I talked about at our annual meeting last year in the way the Department of Revenue is assessing property taxes for unmined minerals, specifically oil and gas. Now, I'm going to be leading us through this in a PowerPoint presentation I prepared. If the way I put this together was so that somebody could theoretically pick up this the PowerPoint and not even need to have anybody lead them through it. So if you're interested in getting it, contact the KOGA office or contact me directly, and I will, or someone in the office will send it to you. I'll just start on Michael, and I don't have the ability to control the PowerPoint from here, so Michael is going to be moving it forward. So I'm going to tell him which page to go to. I hope that's not too disconcerting. If you go forward to the next page right now, page 3. Oil and gas in Kentucky are real property interests, and they're required to be assessed every year. And the owners of those interests are required to pay property taxes. there's a difference between oil and gas and solid minerals like coal or limestone or clay or some other things that the Department of Revenue assesses taxes on. Oil and gas, by their nature, are not minerals in place. They're fugacious minerals. So when you get the right to produce oil and gas, you're just getting it, the right to capture it and produce it. It may be on the property, it may not. By its nature, it migrates. That's different than coal or limestone, where you know, for instance, just how much of the mineral is on the property and how much will ultimately be extracted. So on the one hand, when the Department of Revenue assesses coal or limestone, they have a pretty good idea that you have this many tons on the property, this many tons will be extracted this year, next year, and so forth. And from that point forward, they're able to construct a evaluation of what that stream of income off that property will be. And then once they determine that, they can determine, okay, if the assessed value or the value of the property is say $100,000, and then we'll put the standard county tax rate or whatever the municipality rate is on that mineral. Oil and gas is different. You don't know if it's going to be produced. You don't know if it's going to be there when you drill it. Until you actually start drilling and producing a well, you don't know how much is going to come out. Accordingly, oil and gas are taxed in arrears. What that means is if I produce gas from my property in 2019, I will have it assessed in 2020 and pay taxes in 2020. If I did not produce gas in 2019, I'm not going to have a 2020 tax bill. So it's always going to be 1 year in arrears. And this is one thing that is beneficial to our industry is that unlike other minerals, you're going to pay a tax whether or not you actually produce the mineral. Here, it's going to be a tax after the fact. I like to think of it almost as like an extra % of property or a severance tax that comes a year later, because that's essentially what it is. And when I say 1%, when the Department of Revenue sends out its valuations, it uses a default 1% figure to estimate what your tax bill will be. The reason it does that is it, for whatever reason, doesn't have software that updates the actual county rate, county property tax rate for the county in which the mineral is located. So when you get your assessment from the Department of Revenue, the one thing that is going to show up on your final bill is the assessed value. From there, the county will apply its own rate. But that's just a little background. The way the Department of Revenue gets to the tax bill is either the crude oil purchaser in the case of oil, or the producer, usually in the case of gas, will fill out the gas property tax return lease report or the oil property tax return lease report. On pages 3 and 4, I've referenced what those form numbers are. They're available at the Department of Revenue website under the Unmined Mineral Property Tax tab, if you're interested in seeing them. But really, all they ask for is the owners of the interest, what type of interest it is, whether it's a working interest, a royalty interest, an overriding royalty interest, and what the production from the lease was. Now, from there, after you send that in, the question is, how do I get my tax bill? And that's what I'm going to try to explain a little bit today. Michael, if you move forward to page 4, if you compare this slide and the previous slide, you'll see that oil and gas are taxed exactly the same. Again, you fill out your report, and the Department of Revenue takes the information you get and will create your tax bill. Okay, moving forward to the next slide. This is the valuation formula that Kentucky uses. And so from the lease report, you would take the total value of production. I've got some examples in later slides where I use kind of a default $10,000 value because it gives you a sense of what a $10,000 level of production is going to mean for a working interest owner, for a royalty interest owner, what have you. The next is the decimal interest of ownership in the standard Producers 88 we'd see around here in the Illinois Basin. That would be 7/8 for a working interest, 1/8 for a royalty interest. But obviously, whatever the interest is what's going to be shown on the lease report, and ultimately go into the calculation for the assessed value that the Department of Revenue sends out. Next is going to be what the main focus of my presentation today is going to be about. It's the net present value factor. That's a factor that the department has developed to essentially multiply what your current production is to determine what that final assessed value is going to be. For years, if you dug behind the numbers for a royalty interest for oil producing over $6,500 a year, it would have been a multiplier of 3.12. So you would have, under that example, you would have taken $10,000 of production, your 1/8 royalty, decimal interest, or 0.125. You multiplied it by that 3.12, and you would get whatever that assessed value is. Now, the allowance credit, we're not going to talk much about today. That's essentially a way of discounting the valuation formula or the value for certain situations. And at the very end, I've got what those situations are. Basically, in the first year of production, you're only going to pay 1/3 of what the assessed value would otherwise be. Second year, just going to be 2/3. Once you get to your third year, you're going to be paying the full assessed value, except in the case of water flood, where again you're going to have a reduced factor or reduced allowance, so you're just going to be paying 60%. Okay, so moving on to the next slide, talk about what exactly goes into the net present value factor. The formula Kentucky has used has not changed at all since 1995. So while we are talking about the changes in the formula that's used today, the formula hasn't changed. It's the inputs that go into the formula that create the factors. That's, you know, the way I think about this is almost kind of getting under the hood and taking a look at just how exactly the Department of Revenue determines how are they going to value oil and gas. And there are not very many factors that go into this, really just 4. The first factor is the capitalization rate. The second factor is what's the current price of oil or gas. And when we say current price of oil or gas, the department comes up with a figure for, let's say, 2019. They would go back from the severance tax returns from 2018 and get the average sale price for that calendar year, in oil, obviously, in barrels, and gas in MCF. Next is what percentage of operating expenses are going to be applied for oil or gas. Now, that's only going to affect the operator's interest, the working interest, because those are the only interests that are going to bear a cost of the expenses. And as I'm going through these right now, as we move forward, you're going to see in greater detail exactly how all this works together. And then the last question is, okay, we've got to construct a stream of income so we can get a present value of the income that's going to be coming off the wells, so we can make that final assessment. And that question is, how long is that stream of income going to be? And this is the big issue that came about in the valuation of oil interests for 2019. Okay, next slide, please, Michael. So for the inputs for gas from 1995 to 2018 did not change. So while the formula is there and is intended to move with the market, they got the formula in 95 and didn't change the inputs at all. We started with a capitalization rate of 17%. Same forever. Back in 1995, the income per unit of gas was $2.25 per MCF. That's been the same formula used forever. And operating expenses of 25%. I know if you're an operator, you're sitting there saying that doesn't reflect what my operating costs are or what my revenue is. That's one reason that the formula's been, or the factors or the inputs have been changed. And lastly, the Department of Revenue, in using these inputs, constructed a 12-year stream of income to determine what the value would come off of a gas well. Okay, Michael, next slide, please. What changes do we have for gas in 2019? Well, first, we revised the capitalization rate. Now, I'm not sure where the 17% capitalization rate came from, but what the Department of Revenue is going to be doing going forward is taking, is calculating the capitalization rate as an average of 5 independent sources. They are using, let's see, the state of West Virginia has a number, the Texas Comptroller has a number, the Society of Petroleum Engineers, or the SPE, has a number, and there are 2 other accounting firms, and I can't remember who they are, but the Department of Revenue has taken all of those numbers and averaged them together to come up with, for 2019, it's 12.73%. And then because of the smaller nature of most operators in Kentucky, they added 2%. So you end up with a capitalization rate of 14.73%. Now that drop from 17% to 14.73% does cause a slight increase in the price, or in the valuation. Next, the price of gas for 2019, or for 2018 rather, was not $2.25 per MCF, it was $1.11 per MCF. So the price of gas was reduced. Next, the percentage of operating expenses for gas has increased from 25% to 45%. Lastly, we maintained the same 12-year stream of income to calculate the wells, or the assessed value of the stream of income off the wells. So what is the overall effect of what these changes did for gas? Next slide, please, Michael. Now, what this chart shows is where we were pre-2019 and where we are for 2019 going forward. Now, prior to 2019, we broke down wells between leases producing less than $6,500 annually and leases producing greater than $6,500 annually. Going forward, we've gotten away from that distinction. So when I make some percentage comparisons, I'm going to ignore the wells producing less than 6,500 or the leases producing less than 6,500, and instead focus on the larger wells. Now, if you look at the changes that the formula made for the gas valuation, you'll see that the gas operators come out ahead. The factor that's going to be used to multiply their income and ultimately determine what their assessed value is has gone from 3.08 down to 2.587, et cetera. That's 84% of the previous number. So gas producers essentially got a 16% break from pre-2019 to 2019. What about royalty and overriding interest owners? Well, their taxes go up a little bit. Again, they don't get the benefit of seeing the increase in expenses go from 25% to 45% because they're not bearing any share of the expenses. Accordingly, their factor goes from 4.34 up to 4.71. That's a 9% increase. In the grand scheme of things, not all that bad. Something else to think about. If the Department of Revenue were updating these factors annually the way the formula was intended to be updated, we would have seen much higher tax bills throughout the late 2000s and early 2010s, particularly in the price of oil and even gas when the price of gas was up over 6, when the price of oil was close to 100. So while we can complain today about some increases, particularly in oil that we're going to see here in a little bit, what we're not going to see is increased taxes for all these years where we were assessed as if the price of oil was rock bottom when it was in fact over, or close to $100 a barrel. Okay, Michael, next slide, please. This is what I call kind of getting under the hood. This is how the Department of Revenue takes these numbers. And this first slide, and I'm going to walk through this one in detail. I've got a slide like this for every number that's calculated, but I'll take some time to go through this first one to try to show you what they're doing and how all this plays out. You start with a working interest in a gas well, again with a standard 7/8 royalty. So you've got a 0.875 there at the top. I mentioned earlier that the price per unit was $1.11. So we have $1.11 for our net income per MCF. I'll skip over the factor in the NPV because that's what we're ultimately determining. The capitalization rate of 14.73%. And for purposes of calculating the stream of income, in addition to using the discount rate to give a discounted stream of income, we also assume that production from each well is going to decline at the rate of 4% per year. So that's why if you look at that first column, those numbers are decreasing at a rate of 4% per year. The spreadsheet actually carries it out more than 2 decimals, but if you just for trying to keep it as clean as possible, I just have shown 2 decimal places. The operating expenses, remember for gas I said it was 45%. So start with that 0.97 at the top. That is 7/8 of the $1.11. Next, the operating expense, that's 45% of that 97 cents. The net income, that's your 97 cents minus 44 cents, 0.53. The discount rate is a function of the of the capitalization rate that we've selected. You multiply those together, you get a present net worth for year one of 47 cents. You continue that on all the way down for 12 years, and over 12 years, you get a net present value of $2.52. You take that $2.52 and you divide it by your 7/8 royalty for year one, 2.59. That's the factor that the Department of Revenue is now using for multiplying working interest for gas. Next slide, please, Michael. Same thing with royalty interest, and when I have royalty interest, that's the royalty interest for the owner, but also the overriding royalty interest. Basically, any interest that is not bearing its share of the cost. The one big difference in this one, other than the fact that the numbers are about 1/8 of what they are on the previous chart, is that the operating expense is zero. So your net income is going to be equal to your gross. And again, constructing the same cash flow, we come out with a factor of 4.71. That's the factor that the Department of Revenue is using. Now, Michael, next slide, please. Using a simple calculation, what would a working interest owner's tax bill on $10,000 of production been prior to 2019? That $10,000 lease would have generated an assessed value of $26,950. Next slide, please, Michael. What happens in 2019? Well, as I said, we're only going to tax at about 84% of the value previously. So the assessed value for 2019 is $22,641 for that same $10,000 of production. So for gas owners, it's a tough market, but at least your taxes are not going up. And this is to the extent that you didn't hear any cries out of KOGA when the formula was changed for gas. This is why gas owners get a benefit, at least the working interest owners. Next slide, please, Michael. For royalty interest owners, little bit different. Again, for that same $10,000 lease, the standard 1/8 royalty was going to generate an assessed value of $5,425 prior to 2019. And next slide, Michael. With the new net present value factor inserted, we went up a little to $5,888. I've got an extra one on there. It's the danger of trying to finish your presentation the day you're sending it in and not doing it that last look over. But again, the taxes on the royalty interest and overriding royalty interest went up by 9% for gas working interest owners for 2019. In the grand scheme of things, not all that bad. Next slide, please. Again, I had the chart earlier that broke it down. This is just does the same thing. I used this chart when I presented things at our annual meeting last year that showed what we thought was coming, and this kind of puts everything in one place. Just what happened with your smaller wells or smaller leases, with your larger leases, and ultimately what the new factors generated. So, okay, now for where things really changed. Next slide, please, Michael. Move on into what happened with with oil. This is where we see some big changes in how things have been valued and how things have changed from 2018 to 2019. Again, we start with a capitalization rate of 17%. The capitalization rate is a number that comes out of the oil and gas industry as a whole. They don't break it down by oil or gas, so unless something changes in the future, we don't expect to see that number diverge. We don't see it diverge in Texas or West Virginia, and those are the two states that Kentucky leans most heavily on in coming up with its numbers. Back from 1995 to 2018, the price of oil that was being used, and again, that should say income per unit of oil rather than gas. I'll make that change if anybody requests this PowerPoint that we send out. It was $18 a barrel. Now, obviously, for most of the time since then, price has not been $18 a barrel. It's fluctuated. We know that it got down as low as $10 a barrel in the late 90s, got down to zero a couple months ago, but it also got up to 100 and it's been hovering in the 50s, 60s for much of the time since then. Again, the idea when this formula was adopted in 1995, 25 years ago, was to have this formula be updated regularly. So the $18 a barrel, if you look at that and think that's low, we in the industry have been the beneficiary of not having this formula updated for a long time. The operating expenses for oil wells were assumed to be 35% of the cost of the sale price. And then rather than 12 years, as we did with gas wells, the income stream that we were calculating was for 7 years. So, Michael, if you move forward to the next slide. Again, the capitalization rate went from 17% to 14.73%. And just to give you an idea of how much that'll change, when we first started talking with the Department of Revenue, and we, as Ryan and I met with people in the Department of Revenue back in 2018, we had 2018 numbers. So at that point, the capitalization rate numbers they had would have given us a 14.76% number. So slight change, but nothing great. I don't believe they changed the oil price at all from 2018 to 2019. At least if they have, I have not been able to see where they did it. The numbers seem to work using $44.71, which is what they did with the income per unit of oil. Now, what does that mean? Well, the 2019 tax bills were generated using 2018 numbers. The bills that will be sent out at the end of this year will be used using 2019 numbers. And then a couple of years from now, we will finally get the benefit of the absolutely disastrous price effects we've been suffering for the first part of this year. So you can likely expect to see, I would say, constant or comparable tax rate in 2020 as in 2019, and then in 2021 we'll probably see a significant decrease, and if price gets back to where we hope and think it will, something back up to the current level. But the idea is that it's going to change year to year. As I mentioned previously, the oil expenses were 35%. Those were not changed. Then the big change that occurred that generated some of the emails you saw out of KOGA and recommending that protests be filed to protest the values were because of the last change that I have bolded. Department of Revenue proposed to calculate the stream of income using 12 years of income off a well rather than 7. So in a second, we'll show just exactly what that did. Okay, Michael, next slide, please. So with what the department was proposing, this is what happened with the factors. Again, I'm going to ignore the smaller factors, the less than 6,500, since most wells that are productive should be producing more than, or most leases should be producing more than $6,500. And when I say more than $6,500, that's not just for an interest holder, that's for everybody under the well. So all the production would be $6,500 or greater. Previously, that working interest factor was 1.74. With what the Department of Revenue came out with, they went to 3.02 and change. That was a 74% increase of what the factor was previously. Similarly, with royalty interest and overriding interest holders, we went from 3.12 to 4.71. Not as big an increase as with working interest holders, but a 51% increase. So again, massive increase on a market that, frankly, at the end of the year was struggling. This was not what we wanted to see as prices were falling. Okay, Michael, next slide, please.
John, this is Ryan. Before you proceed, I just wanted to say we are almost through the presentation, and if anybody, the participants on the phone call, if you would like to ask some questions, I think there's a chat or a Q&A feature on there. You can type that and send that to the host and panelists. So John can answer those after he's complete with his presentation. So John, sorry to interrupt. I'll turn it back over to you.
Okay, thanks, Ryan. Okay, again, the way these charts work is the same for all interests. Again, you can see the working interest in oil. A lot of the factors look the same, except as they would for gas, except for one thing. Instead of having $1.11 per barrel, we have $44.71. So you take that and you multiply that by 7/8. You end up with the 39.12 in year one for production. The operating expense, 35%. That's where that 13.69 comes. Net income is the second column subtracted from the first column. You take the discount rate of 14.73, what that is at the end of year one. The owner interest should be worth $22.16 net of expenses at the end of, at least for year one. You do that continuing on for 12 years, you get that total stream of income of 118.34. You divide it by the year one realization, or sorry, the year one income, and you get that 3.02 factor. Now, Michael, next slide. Same thing happens with the operating expenses, or sorry, with the royalty interest. Only the operating expenses are shown as zero, and the factors work the same. Now, next slide, please, Michael. What I have here is, and again, I'm not going to walk through these in detail. Once you've done through the gas ones the way we have, they all work the same. Again, you see that factor of 1.74 on a $10,000 production lease would yield an assessed value of $19,886 for a standard 7/8 working interest holder. Next slide. But with what the department was proposing to do, that $19,000 and change, almost $20,000, became $26,000, almost $26,500. So a significant increase for the assessment. Again, next slide. Same thing with the royalty interest. We go from that $10,000 well or $10,000 lease. I keep saying well. If there's more than one well on a lease, you'll be assessed on the lease basis, not just on the well basis. So it's all aggregated as one. It doesn't matter now since we're not having the $6,500 threshold. It did matter before that. But anyhow, so our $10,000 in production pre-2019 gave us a $3,900 assessment for the for the royalty holder. Next slide, please. But for the with the new increased assessment that the department was proposing, $5,800. Again, significant increase. Okay. Now, what was KOGA so upset about? KOGA was upset not just that taxes were going up. Whether our membership likes it or not. Back in 1995, we did adopt a formula that was intended to, I'll say, live and breathe with the market. As prices went up, the value of oil should go up, and as prices went down, the value of oil properties should go down. The fact that we never did it meant that we were undertaxed for many years, overtaxed for a few, but for the most part, undertaxed. When the 2019, actually, when Ryan and I first sat down with the department back in 2018 and really looked into the formula, we saw no good reason why the value of oil wells should have been calculated using a 12-year stream of income versus 7. Nothing had changed as far as we were concerned about the way oil was produced. Back in 1995, say in this basin, you'd have the Cypress wells that would have run like diesel engines and produced for 30 years, 40 years at a more or less constantly declining rate. The fact that wells last a long time isn't reason enough. For instance, with gas wells, we only look for a 12-year stream of income, but we all know that we have gas wells in eastern Kentucky that are on leases that were taken back in the late 1800s. But we're not looking for a 100-year stream of income to do that. So the question is, what was a reasonable stream? Was there a reason to go from 12 to 7? And that's where we sat down and ultimately we thought convinced the department that there was no reason to go from 7 to 12. We think the reason they wanted to do it was just to standardize it. Well, if we go 12 oil or 12 gas, we may as well go 12 oil. They talked to their consultant, and their consultant, as we understand it, agreed that no, there's nothing that's fundamentally changed that would require us increasing the stream of income off of oil wells from 12 or from 7 up to 12. So next slide, please, Michael. So the next thing I have in here is dropping those 3 years off. What does that do? The stream of income off 7 years for a for a oil well for working interest is $96.78. Now, you'd have to be thumbing back and forth between the other slides to see that, but that's a decrease from where we were previously of 118.34. So 118 to 34, or sorry, 118 to 96 is a significant decrease. So what did I say previously? That we had an increase of under our assessed value of 74%. That's only a 42% increase from where we were. So Michael, next slide, please. Again, I have the same thing for the royalty interest, and then next slide. This is the net effect of what KOGA was able to do in our meetings with the Department of Revenue, and also I think the massive influx of protests that were filed. You can see there by getting these stream of income off the wells decreased from 12 years down to 7 years, or holding it 7 years, frankly. Instead of a factor of 3.02, we end up with a factor of 2.47 for working interest, and for royalty interest from 4.71 down to 3.8. So instead of the 74% and 51% increases, respectively, we have only a 42% increase on working interest. I know people aren't happy about that, but we think that accurately reflects what the formula was trying to capture. And then for royalty and overriding interest, 22%. The one thing I think that is worth noting is that you may recall that back when the assessments or the protest deadline was coming due in January, KOGA was sending out a lot of emails encouraging people to protest. The department was, I'll say, swamped with the number of protests. So had it not been for the number of KOGA members who protested their assessments, it's likely if it had just been one or two, they might have actually fought it. By the industry coming together and making a unified, frankly, overwhelming response to the changes, we were, I think, able in part to have the department say, we really don't want to be dealing with all these protests, and thought, well, we had agreed to change it back to 7, and I'll break off there a little bit. To this day, we don't know why there was a breakdown in the department. Ryan and I had spoken with one person in the department who was their chief liaison for purpose of evaluation formula, and had an agreement that they would be using a 7-year stream of income. For whatever reason, I think there was a breakdown in communication there, and the department inadvertently retained the 12-year stream of income, and rather than just back it off unilaterally, we were forced to mount the protest effort. So a lot of good work from a lot of people went into doing that. I don't know if Bill Barr is on this call or not, but he was the chief author of the letter that we were sending out to protest assessments, and a lot of people were working on this on the legal committee and on the governmental affairs committee. Okay, next slide, please, Michael. Again, I go through the calculations that show what the changes were. $21,645, like I said, is a 42% increase over what the department was proposing, or what they were taxing on us in 2018. But it's better than a 74% increase. Those are real dollars, and while we would like to have the taxes be less, we do think the formula, as updated now, accurately reflects what it was intended to do when it was adopted back in 1995. Next slide, please. Again, same example for royalty interests. Again, rather than having the 51% increase, that 4757 is only a 22% increase in the assessed value, which will necessarily mean a 22% increase in the bottom line tax bill. Okay, next slide, please, Michael. Again, this is just the same thing that I kind of had in my presentation last year at the annual meeting. Same thing I had on one of the previous slides, just in a little bit different format. And the bottom line is, again, KOGA's work in those bottom two numbers means that we have a factor for working interest of 2.47 rather than 3.02, and for royalty interests for 3.8 rather than 4.7. Again, that's higher than the pre-2019 levels, but it is a significant savings to the industry as a whole. Okay, next slide, please. Now, remember when I started this, I showed this formula. We've been working through it. For all the examples, I've used the allowance credit of 1, which is to say you have a well that's in its third year of production or greater and is not a water flood. So anyhow, next slide, please. If you want to sit down and work through your numbers yourself, these are the allowance credits you would use. First, your gas production. You start production on a gas well in 2019. Your lease report for 2020 is going to show that you have first year gas production. So when you have that assessed value, rather than, and again, take the $10,000 number, right off the top, you're just going to multiply that by 1/3. So, and this is just a word of advice, as you're reviewing your tax bills when you receive them, if you have new wells, being able to chop 2/3 or 1/3 off the value by catching an allowance that was not properly applied is the easiest way to save money. There were several instances that we know of last year where new wells did not have the allowance credits applied to them. So one reason to take a close look. Next slide, please, Michael. Again, and this is oil, looks almost identical to what we have for gas. The only difference is for water flood oil production, you have a 0.6 allowance. Otherwise, the allowances are the same. Next slide. Again, the whole point of this is to try to show people exactly how the department comes up with its numbers. And a couple of thoughts. First of all, the formula that the department uses is intended to approximate how you would assess a run-of-the-mill oil or gas well in Kentucky. And for most of the wells that people have who might be reading, watching this or looking at this presentation in the future, that's going to be sufficient. Occasionally, there will be circumstances where your wells may decline more rapidly. In those cases, you may still have a potential to protest an assessment. For instance, if you have a gas well that's an unconventional well, which of course we don't have any in the state right now, but where you would have a massive decline very quickly, proposing a different assessment using something other than the 4% decline each year might be appropriate. If you have a well that's declining a lot greater, you can always have the option of making a protest and digging into those numbers and saying, this is what your formula is predicting. That's not the realities of what we have here. Similarly, the expenses that are used may be, your well may have higher expenses. If your margins are not the 55% on a gas well or 65% on an oil well, and it's significant enough to make a protest, by understanding where the numbers come from, you can say, that doesn't reflect what my well does. You should calculate your assessment differently. The other thing is, as with the surface property, for those of you who are Kentucky property owners, you'll get your assessment from either the sheriff in the case of, or the PVA in the case of property owners, surface property owners, or from the Department of Revenue in the case of mineral owners. Be sure to look at it. Take a look at just what exactly it reflects. You have one bite at the apple in terms of protesting. If there's something wrong, you don't realize it until after the fact. You've lost your chance to protest it. So pull out your lease reports, see if the numbers look consistent. And now that you have this information here, you could go back and frankly put each lease in a spreadsheet and know almost as soon as you submit your lease report what your tax bill is going to be, because you'll already know the county tax rate at that point. Ryan, Stacy, that's all I have. If anybody has any questions, I'll be happy to take them.
Okay. did have received just kind of a comment here, but before we dive into that, I just want to recognize Cumberland Valley Resources. I omitted them earlier. So, if Rudy, I know that you had signed up for the call, and we really appreciate your continued support as well. I'll read this comment, John, and then you can see whether or not you want to comment on the comment. It was great doing this. It took us a great deal of money. Now, if we could utilize this increase to justify getting faster turnaround of Class 2 permits, for all intents and purposes, it is a year. Oil and tax receipts require water injection. You know, if you had any comments on that statement.
You're talking state government and you're talking right hand, left hand. Bill Barr might be better suited to answer this question in some respects, but if you look at the property taxes that we pay, they go into the they go into the general fund. Unlike, say, the severance taxes, which in part are returned to the mineral producing counties. If you look at the tax reconciliations we have, the amount of taxes we pay is more than sufficient to run the Department of Oil and Gas. We between the severance taxes and the property taxes on oil and gas, there was already plenty of money even before they changed the formula. But I guess two things. One, like I said, it's right hand, left hand. There's no direct correlation between, one, money going into the Department of Revenue, and two, what shows up in the budget of the Division of Oil and Gas, as opposed to, say, the fees that we pay for permitting wells. A more like-for-like comparison would be the fees that a coal company or an oil and gas company pays to file a permit or have a permit reviewed versus the cost to administer the department. This goes into the general fund, so it doesn't end up directly as a payment to the division. The other thing is, in the current atmosphere, I think that if we can maintain the current levels of service that we have in the state, we will be ahead of the game, because the coronavirus and the resulting quarantines are going to put a huge hit on income in the state, and I don't see changes happening. But again, governmental affairs people may have a better take on it than I do.
And we will have that presentation hopefully by Dennis Hatfield in a couple of weeks. So if the folks who are on the call right now, if you have any questions, you could direct my way. I could send those to the division director just to put those on his radar to kind of address in his presentation as well. I'm not really seeing any more questions rather than comments. We appreciate all the comments coming through and kind of the continued support. I want to personally thank John Henderson, and Karen Greenwell, I think she's on the phone, and Bill Barr, who did the lion's share of the work on this, and really added extreme value to your KOGA membership if you are a KOGA member. If you're not a KOGA member, this is one of the reasons why we fight for the industry. It's because of these reasons, advocacy. It's the bread and butter of our association. So once again, if you're not a member, please consider it. Chat with me, and my contact information is on the Kentucky Oil and Gas website, which is www.koioilgas.org. Anything else, John, before we conclude? And we want to appreciate you for taking the time today and giving this presentation.
No, again, I want to reiterate what you said. Karen has been the chair of our legal committee for, I don't know how many years, I think at least 7, and has done an excellent job, and it has been important on not just this issue, but also on issues like the PHMSA issue and some other things that I believe we'll be hearing about in coming presentations. And Bill Barr, who's been a longtime governmental affairs leader and very active, not just in that, but also on the oil and gas working group with the secretary and with the Department of Natural Resources, but also some environmental interests, and that effort has has been valuable. Because it's not just a tax issue, it's a legal issue, it's a governmental affairs issue. It all comes together. And then Ryan, you were you were in all those meetings with the Department of Revenue with us from the beginning, and your help was also very valuable. So it's very much a team effort, what we do here.
Absolutely. And thank you, John. And I want to thank Country Mark and Ergon and all of our sponsors who sponsored today. We will meet this same time next week, Tuesday at 2 p.m., which will feature Kentucky Secretary of State Michael Adams on the upcoming primary election that is co-hosted by the Kentucky Coal Association. And then the following week will be Dennis Hatfield of the Kentucky Division of Oil and Gas. So like I said earlier, if you have any questions that we can present prior to their event, hopefully they'll answer those during their presentation. Again, thank you. And Stacy, Michael, Country Mark, I'll turn it back over to you. And I think we are good to go for today's. And be sure to answer the survey. We want to make sure that our next presentation is seamless and flawless. So if you had any difficulty hearing or that type of thing, we want to fix those bugs before our next presentation. So once again, thank you, and we'll see you next Tuesday.
Thanks, guys. Appreciate it.
Thank you all.